Owning a rental property in Canada is hard, but it still might be one of the most unfair financial advantages available to regular homeowners. And it's not because you can just collect rent, it's because of our tax code. Most Canadians are getting crushed by two things: income taxes and the mortgage on their home. And that mortgage interest is usually dead money. You pay it, you don't deduct it, and you don't get anything back. But there's a way that landlords are able to also claim that interest to get back extra tax refunds. And that's where a strategy called rental cash damming comes into play. Consider this: an $800,000 mortgage on your home is going to cost you about $620,000 in wasted interest over the next 25 or 30 years. And most people are just going to eat that. But what if you can start claiming that interest to get back tax refunds? And what if you use those tax refunds to pay off your primary residence mortgage like 10 years early? So you can pay off your mortgage early without having to increase your payments out of pocket and without any drastic lifestyle changes. You just have to make two simple changes. I'm going to walk you through a high-level overview of how this strategy works, but if you want a detailed 30-minute video, just comment below and I'll point you in the right direction. Most people with a home and a rental property use their salary to make the mortgage payment on their home, and they use the rental income to make the mortgage payment and cover all expenses on the rental property. But this is a mistake. What you want to do instead is take your rental income, apply it as a prepayment to the mortgage on your home, still make your regular mortgage payments, set up a readvanceable mortgage with the right bank, use this line of credit to cover your mortgage payments and all expenses every month on your rental property. What this does is it gets rid of your mortgage fast, moves it over to a tax-deductible line of credit. The interest on this line of credit, because it's tax-deductible, can lower your total taxable income, generating tax savings, usually tax refunds, which we use to pay off the mortgage faster. Both of these debts usually get paid off years faster than if you just kept the regular mortgage amortization on this property. This doesn't mean that everybody with a line of credit can start claiming the interest on their mortgage. You need the right setup, the right interest tracking, the right bookkeeping. You need the right CPA and mortgage team to make sure that this is done correctly. These savings could be in the several hundreds of thousands of dollars for most people, but you got to get it right. The CRA does not like giving back tax refunds, so work with the right team, make sure you get this done properly, and if you want to learn more, comment below.